Look back every 3 years. Did you miss anything that you can go back and get? Like a historic easement or a conservation easement, where you give up development rights, or you find a property and you agree not to tear it down and you preserve the facade and you get this major tax benefit. We had someone that had snapping turtles on their land, and so they did a conservation easement, and those turtles are endangered, I believe, so they got a really high valuation. Or someone else that could have done fracking on their land in West Texas, and when they got that development, they made it a fracking property, they got a major tax advantage that was actually worth more than what they spent on the land. That's why I like the third category as the biggest way to save tax, and this is really what the tax attorney is responsible for, which is reclassification or classification of income, which comes in 4 categories. I'll give you each category, and I'll give you some ideas in each category, and then that'll just see how it works. Now, some of these might not apply to you, but it can plant a seed of how it might apply in the future. By knowing now, it can really matter. Or you just go, oh, that doesn't apply, but this does. So the first thing is, can you move your active income to passive income for tax purposes? I'll give 2 examples in a minute. Number 2, this is for people that make a lot of money. If you're making $650,000 taxable, this second thing is a major benefit. But if you're making $70,000, it doesn't matter. It's, can you turn your ordinary income into capital gains? See, because capital gains, if you're in the top tax bracket at 37.5% and capital gains are 20%, that's 17.5% that you're not paying if it's capital gains versus ordinary income. The third one is tax-free income. I'll give you some suggestions there. And number 4 is tax arbitrage. That's simply saying if I spend $1, I get more than $1 back, an actual tax credit, not tax deduction. So first one, active to passive. This has been around forever. Sometimes people say, oh, I've heard about it, but I heard that they're going to change it. Like once I think it made it through the Senate, but not the House, or vice versa. So it has come up for debate, but you can set up an S corporation if you're the only owner, or maybe it's a PC if you're a doctor. But ultimately, you can take a reasonable salary, which is, what would you pay someone else to do that job? What would you pay someone else? And you can look at the median or the mean and say, this is what you might be paid. And then you can take the rest in distributions, because when you're actively working in the business, that's salary. When you're working on the business, that's distributions. So that's kind of the distinction there. And some people pay for studies on it. Some people just do inventory over a month of how much time was spent. The more documented it is, the more you might be able to justify a higher distribution than salary. Some people go really aggressive, like 10% salary, 90% distribution, but 70% of their time is spent working in the business. It really comes down to, do you have a CEO, and do you have a COO, and do you have other doctor? The more you have a team infrastructure, the more you're operating as a business owner and less as running the business inside of it. So that would justify more distributions when you're being an owner versus a runner. So active versus passive, you're just taking maybe the same amount of income, but just in 2 checks instead of 1, W-2 and 1099. This is just active to passive, which saves you a minimum of 3.2% and as high as 15.3%. Yeah, the FICA, FUTA, Medicare, all that kind of stuff. This is simply making it more passive because it's a distribution. I'll get to the ordinary income to capital gains in a second, but the second piece of this active to passive is, let's say you have a doctor that owns their building. Well, charge the highest rate that you can that's comparable. Some people might be really conservative or low on that, but no, make that a higher rent, because 1, if you sell the practice, now you can keep that higher rent if you keep the building. 2, that's coming in 1099 without all the self-employment tax. So it's a more efficient passive-based income that's coming in. So those are 2 examples of active to passive, S corp or higher rent. There's other ways to do it, but I just want to give a few good examples that are a high potential. The second one is what you were talking about. How do we go from ordinary income to capital gains? Well, something that you could do is an international sales corporation. Let's say that you sell, let's say you're a doctor and you sell supplement. Well, if you sell those internationally, you could take all that through the international sales corporation that comes in capital gains, because they want that money to come back to the U.S. Or maybe you're selling education. You're selling education. You have clients in Canada. They could be paying your international sales corporation, so you're paying capital gains instead of ordinary income. So it's anything that would be international can come into that, because they want that money to come back to the U.S. So they've incentivized you with that capital gain. The next strategy is, I would say, slightly risky, because it's not technically a tax strategy. It just happens to have tax benefits. This is a risk management strategy. There's so many people out there that are facing all these risks. They're having their insurance costs go up and it's frustrating. Well, they can set up their own insurance agency, a captive insurance agency that's an 831A or 831B. 831B is fully pre-tax, so people get excited about that. But let's say they don't make claims when they are supposed to make claims. They don't treat it like an insurance company. They treat it like a tax advantage. It could get audited and they can say, you know what, you didn't make a claim even though you had this issue. You would have made a claim if it was another insurance company, so this was just a tax thing. I've had one client lose in an audit. I've had several win audits, and I have one of these, and they didn't audit me because when they said they wanted to talk to me, I wrote a letter about risk management because that's the business I'm in, and they said, okay, that's suffice. So they just know a lot of people abuse these because I am talking about it here in the tax realm where you can put it in pre-tax. If you don't make the insurance claim, you can pull it out as a capital gain. And that's very attractive to a lot of high income earners, especially because you can put up to 2.3 million per year into this. So it's pre-tax, it grows tax deferred, and then you can take it out capital gain instead of ordinary income. They are onerous to set up. I would highly recommend you only go with a place you're doing a feasibility study so you know what lines of insurance you're using. You might raise deductibles, drop other insurances because this covers it for you. You can add a 2% premium, get reinsurance that says you're insuring more than the cash that you have in there for your company. And even companies like Geico started as a captive. So, I mean, this is pretty much you're going to find every Fortune 500 uses this, but they use it because they have things they want to insure that are hard to get insurance on. And it becomes a really nice pool of funds for them to do just that. And then the third category is tax-free. A couple ideas for tax-free. First one is you're a C corporation and you've been around for 5 years. When you sell, you can use Section 1202 and sell up to $10 million per partner tax-free. So that's a major advantage. Charitable trusts. You could take a highly appreciated capital gain asset, like a piece of real estate or a practice or a stock. Anything that's got growth in it that if you sell, you'd be paying tax on the growth. You could put it in a charitable trust, which is you find a 501c3 charity that you align with, that you say, I want to benefit this charity. You can donate that asset, and when it sells, there will be no tax on the sale, and there will be a partial tax deduction on the donation. Partial because they're thinking, what amount would you be leaving to the charity when you die? Let's give you a benefit for that today. Then you get to take an income off of that during your lifetime. Minimum of 5%, maximum of 50%, depending on your age and the underlying asset. Ultimately, that's including some principal and that kind of stuff because the goal is, or the intention is, at least 10% to the charity upon death. So what happens when you die, the charity keeps what's left over. That's why it's a remainder trust, but you're the first beneficiary of the trust. They're the second. Avoids capital gains, partial tax deduction. So when you sell something, you now have the full amount at work, not a partial amount after tax. So that's a tax-free strategy. Let's go to tax arbitrage. Just talk two strategies here. One, I have an art investor that I buy art from, and then I hold it for 3 years, and then I donate it to museums. And because I buy collections at a deep discount, I then donate them, and it ends up being about 5.5 to 6.5 to 1, which turns out to at least $2 back for every dollar I spend. 5.5 to 6.5 to 1 tax deduction, which means the tax credit's around 2 to 1. I've donated to a bunch of different universities that have museums, and bought photographs from pretty famous artists that I demonstrated. I had them all over my house and my office for years. At one time, I even rented them out over years to people that were officing and said, would you like art? And they paid a monthly fee to have the art in their office. It was pretty cool art. That was a little extreme, but then I donated it and I got back all this tax benefit. So that's tax arbitrage. Another example would be like a historic easement or a conservation easement where you give up development rights, or you find a property and you agree not to tear it down and you preserve the facade, and you get this major tax benefit for keeping that facade, even though you can still rent it out and even though you could still office in it. But if it's a conservation easement, it might be you never can develop whatever you're giving up, and they'll give you major tax advantages. We had some that had snapping turtles on their land, and so they did a conservation easement, and those turtles are endangered, I believe, so they got a really high valuation. Or someone else that could have done fracking on their land in West Texas, and when they got that development, they made it a fracking property, they got a major tax advantage that was actually worth more than what they spent on the land, and they didn't want to frack and go through that. That wasn't their business, but it was a kind of hard land to sell, so they got really major tax advantages for preserving that land. So those are a couple ideas: historic easement, conservation easement, and even in this art. So we have 3 categories: team, deductions, and classification. 4 types of classification: active to passive, ordinary income to capital gain, tax-free, and tax arbitrage. Look back every 3 years. Did you miss anything that you can go back and get? Look at all your deduction options, not just what you write off because you spend money, but where do you get tax credits because of specific types of actions. We didn't even mention like opportunity zones that can work in that as well, where you're buying property in a place where the government's saying, hey, we need a lot of help here, so we'll give major tax advantage for development in this this area. There's so much that's out there. And I think the reason why it's hard to get all of this is it requires a team, and that team has to communicate. If that team doesn't communicate, it gets really complicated, and we're busy. And also we're afraid. Oh, my accountant says they're conservative. I once spoke to a group of doctors. I talked about paying your kids. I didn't even mention this one yet. You can pay your kids. It's just over $13,000 now. And when you pay them that, you have to actually have them do the work. This is the reason why people get scared of this. They pay their kids, they don't have them do the work. Well, that you're taking a right. That's an evasion, not an avoidant. And plus, you could teach them lessons about paying them. Well, I told someone, you could pay your kids. There's a few activities you could pay them for. And they went to their accountant, and their accountant said, "This guy's maybe should stick to being a comedian and an entertainer, and he's not an expert. I'm not willing to help you. This is." And then I looked at his Facebook profile, and he had his arm around the commissioner of the IRS. He's working for the wrong team. This is absolutely just part of the tax code. It's something that you can do. You can pay your kids. They're in their tax rate, which is 0% up to $13,000. And then they have a lower tax rate than you even after that. So it's just a matter of understanding how the law works and then managing within the constraints of the law, not being afraid about it and just saying, I guess you just have to pay tax. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from, so go ahead and click through and watch the next video now.